Imagine a world where you could invest in sprawling shopping malls, bustling apartment complexes, state-of-the-art data centers, or even the very cell towers that power our communication, all without the colossal down payment, the endless paperwork, or the headache of tenant management. Sound like a dream? Well, it's not. This is the reality offered by real estate investment trusts, or REITs. Think of REITs as the mutual funds of the real estate world. They are companies that own, operate or finance income-producing real estate across a diverse range of property sectors. Instead of buying an entire building yourself, you buy shares in a REIT, which then pools your money with that of countless other investors to acquire and manage a massive portfolio of properties. This ingenious structure allows individual investors like you and me to tap into the lucrative world of large-scale real estate, enjoying the benefits of property ownership, primarily through steady dividend income without the traditional burdens. The allure of real estate investment has captivated humans for centuries. It's tangible, a physical asset that you can see and touch, often perceived as a reliable hedge against the relentless march of inflation. Historically, property values tend to appreciate over time, and rental income provides a consistent cash flow. For many, owning property represents stability, wealth accumulation, and a tangible legacy. However, the path to becoming a real estate mogul is fraught with significant barriers. The capital requirements are astronomical. Purchasing even a single commercial property can demand millions. Then there are the management responsibilities, finding tenants, dealing with repairs, navigating legal complexities, and constantly monitoring the market. And let's not forget the inherent illiquidity. Selling a building isn't as simple as clicking a button on your brokerage app. This is precisely where REITs step in as a powerful solution. They democratize real estate investment, tearing down those traditional barriers. With REITs, you can invest with far less capital, gain instant diversification across multiple properties and geographical regions, and enjoy the liquidity of publicly traded stocks. You can buy and sell shares on major exchanges, just like any other stock, providing unparalleled flexibility. Given these compelling advantages, a critical question arises. Why aren't more people leveraging this incredibly potent investment vehicle? If REITs offer such an accessible, diversified, and liquid pathway to real estate wealth, what's holding investors back? The truth is, while the benefits are undeniable, investing in REITs isn't a walk in the park. It's a sophisticated landscape, with its own unique set of rules, metrics, and potential pitfalls. Many investors, drawn by the promise of high dividends and real estate exposure, jump in without truly understanding the crucial nuances that differentiate successful REIT investing from mere speculation. They might overlook critical financial indicators, misinterpret market signals, or simply be unaware of the specific tax implications. That's why we're here today. In this series, I'm going to reveal 10 essential facts that every aspiring and current REIT investor needs to know. These aren't just minor details. These are the foundational insights that separate the smart strategic REIT investors from those who fall prey to common mistakes. Understanding these facts could literally save you from significant financial pitfalls and, more importantly, empower you to maximize your returns, building a more robust and resilient investment portfolio. Before we continue, subscribe to the channel and tell us in the comments where you are watching from. To truly master the art of REIT investing, we must first journey back in time to understand their origins and the foundational principles upon which they were built. The concept of real estate investment trusts isn't new. It was formally established in the United States in 1960 under the visionary Eisenhower administration. The original intent behind this legislative act was remarkably democratic, to provide all investors, regardless of their net worth, with the opportunity to invest in large-scale income-producing real estate. Prior to this, investing in commercial properties was largely the exclusive domain of wealthy individuals and institutional players. REITs leveled the playing field, creating a mechanism for ordinary citizens to participate in the profits generated by office buildings, shopping centers, and industrial parks, much like they could invest in a factory or a tech company through the stock market. It was a pivotal moment, transforming real estate from an opaque, illiquid asset into a more accessible and transparent investment vehicle. Central to the design and ongoing operation of REITs is a crucial regulation known as the 90% rule. This mandates that a REIT must distribute at least 90% of its taxable income to its shareholders annually in the form of dividends. This isn't just a guideline, it's a critical requirement that unlocks a significant tax advantage for the REIT itself. By adhering to this rule, REITs avoid corporate income tax at the corporate level. This means the income is taxed only once, at the shareholder level, preventing the double taxation that typically applies to most corporations. However, this benefit for the REIT comes with a specific consequence for investors. The dividends received from REITs are generally taxed as ordinary income, not as qualified dividends, which often receive a lower tax rate. This distinction is one of the most frequently overlooked details by new REIT investors and can significantly impact after-tax returns. Beyond the general umbrella of REIT, it's vital to recognize that not all REITs are created equal. They can be broadly categorized into several types, each with its own characteristics and risk profiles. The most common are equity REITs, which are what most people envision when they think of REITs. These companies own and operate physical income-producing real estate assets like apartment buildings, shopping malls, office complexes, and even specialized properties such as data centers or industrial warehouses. Then there are mortgage REITs or MREITs, which operate differently. Instead of owning properties directly, REITs provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. Their income is generated primarily from the net interest margin between the interest they earn on their mortgage assets and their funding costs. REITs typically carry higher risk, but also offer the potential for higher returns. Hybrid REITs, as their name suggests, combine strategies of both equity and mortgage REITs. Furthermore, the world of REITs continues to evolve, with specialized sectors gaining prominence, including those focused on cell towers, timberlands, and even infrastructure. Understanding these distinctions is crucial for proper portfolio construction. One of the often cited advantages of certain types of REITs is their potential to act as an inflation hedge. When inflation rises, the value of real assets, including real estate, tends to increase. This can translate into higher property values for equity REITs. Moreover, many REITs, particularly those with short-term leases or leases structured with inflation-linked rent increases, can pass on rising costs to tenants, thereby increasing their rental income. For instance, an apartment REIT might be able to raise rents more frequently in an inflationary environment, or an industrial REIT might have leases tied to the consumer price index. This natural correlation can help preserve purchasing power during periods of rising prices, making them an attractive component of a diversified portfolio. However, just as you wouldn't invest all your capital in a single stock, the principle of diversification applies equally, if not more so, within the REIT sector itself. Just because you own one REIT doesn't mean you're fully diversified. Different property types are sensitive to different economic forces. A retail REIT, for example, might struggle during an economic downturn or a shift in consumer spending habits, while a data center REIT might thrive due to increasing digital demand. Similarly, geographical diversification is key. A REIT focused solely on a single metropolitan area could be heavily impacted by local economic shifts or regulatory changes, whereas a nationally diversified portfolio would spread that risk. Economic cycles impact various REIT sectors differently, making it imperative to spread your investments across different property types and locations to mitigate risk and capture opportunities. Continuing our deep dive into the world of REITs, it's time to unlock the advanced considerations and actionable insights that empower truly strategic investors. These aren't just theoretical concepts. They are the practical tools and perspectives that can significantly impact your investment outcomes. Fact 1. Funds from operations versus net income. When evaluating a REIT, traditional net income, often used for other companies, can be misleading. This is because real estate assets undergo significant depreciation on paper, which reduces net income but doesn't reflect the actual cash generation or value appreciation of the property. Instead, the industry standard metric for assessing a REIT's operating performance is Funds from Operations, or FFO. FFO is calculated by taking net income, adding back depreciation and amortization, and subtracting any gains from the sale of property. This provides a clearer picture of the cash flow available to a REIT for distributions and reinvestment. An actionable tip here is to always scrutinize a REIT's FFO per share and its growth trajectory. Consistent FFO growth is a strong indicator of a healthy and expanding operation. Fact 2. Debt levels and interest rate sensitivity. Real estate is inherently capital-intensive, and debt is a common tool for financing property acquisitions and development. While leverage can amplify returns, high debt levels introduce significant risk, especially in an environment of rising interest rates. As rates climb, the cost of borrowing increases, potentially squeezing a REIT's profit margins and making refinancing more expensive. Savvy investors check metrics like debt to EBITDA or debt to asset ratios to gauge a REIT's financial health and its capacity to manage its obligations. A REIT with manageable debt and a strong balance sheet is better positioned to weather economic shifts. Fact 3. Management quality and alignment. The people running the REIT are just as important as the properties it owns. Look for experienced management teams with a proven track record of successful acquisitions, property management, and strategic capital allocation. A key indicator of alignment between management and shareholders is significant insider ownership. When executives have their own capital invested in the company, their interests are directly aligned with yours. Conversely, excessive executive compensation that isn't clearly tied to performance should be a red flag, suggesting priorities might be misaligned. Fact 4. Location, location, location. Even within a diversified portfolio of REITs, the fundamental principle of real estate, location, remains paramount. The underlying property's locations dictate their long-term value, rental income potential, and resilience. Consider factors like demographic trends, local economic growth, infrastructure development, and regulatory environments. A property in a thriving, growing urban center will likely perform differently than one in a declining region, regardless of the REIT's overall strategy. Fact 5. Lease structures and duration. The type and duration of a REIT's leases significantly impact its income stability and sensitivity to economic changes. Short-term leases offer flexibility to adjust rents more frequently, which can be beneficial during inflationary periods, but also expose the REIT to higher vacancy risk. Long-term leases provide predictable income streams, but might lock in rates that become unfavorable during periods of high inflation. Understanding the difference between net leases and gross leases is also crucial for assessing a REIT's expense structure and net operating income. Fact 6. Understanding cap rates. The capitalization rate, or cap rate, is a vital metric in commercial real estate, representing the expected rate of return on a property based on its net operating income and current market value. It's calculated as net operating income divided by the property's market value. By comparing cap rates for similar properties in similar markets, investors can assess whether a REIT's acquisitions are reasonably valued or if they are overpaying. A declining cap rate environment often indicates rising property values and lower expected returns on new acquisitions. Fact 7. The impact of economic cycles. No investment exists in a vacuum, and REITs are particularly sensitive to economic cycles. Different sectors perform differently depending on the stage of the economy. For instance, industrial REITs might thrive during e-commerce booms, while retail REITs could struggle during recessions. Healthcare REITs might be more stable due to consistent demand, whereas office REITs face challenges with remote work trends. Understanding the cyclical nature of your chosen REITs and how their specific property types react to economic shifts is essential for managing risk and optimizing entry and exit points. Fact 8. Publicly traded versus non-traded REITs. It's critical to distinguish between publicly traded REITs, which are listed on major stock exchanges, and non-traded REITs. Publicly traded REITs offer superior liquidity, transparency, and regulatory oversight. Non-traded REITs, conversely, are often illiquid, have higher fees, and are less transparent, making them generally unsuitable for most individual investors. For the purposes of accessible and liquid real estate investment, always focus on publicly traded REITs. Fact 9. Tax considerations beyond dividends. While we've discussed the ordinary income taxation of REIT dividends, it's also important to consider other tax implications. Selling REIT shares, like any other stock, can trigger capital gains or losses. The tax treatment can vary based on your holding period and individual tax situation. Always consult with a qualified tax professional for personalized advice, as tax laws can be complex and impact your overall returns. Fact 10. REITs in a diversified portfolio. Finally, remember that REITs, while offering unique benefits like income generation and potential inflation hedging, are just one component of a truly well-diversified investment strategy. They should complement, not replace other asset classes, such as stocks, bonds, and alternative investments. A balanced portfolio allocates assets across various categories to mitigate risk and optimize returns over the long term. These 10 crucial facts are not merely academic points. They are the bedrock of informed REIT investing. They empower you to look beyond the appealing dividend yield and delve into the fundamental health and future prospects of the underlying businesses. Conduct your thorough due diligence, armed with this knowledge. What other aspects of REITs would you like to explore? Share your thoughts in the comments below. Investing in REITs can indeed be a powerful tool for wealth creation, but only for those who are well-informed, strategic, and committed to continuous learning.